Hello, everyone. Thank you so much for joining me. If you're joining me, I apologize. This was supposed to get way under at 11 a.m. and I thought that I had learned everything I needed to learn about
Hello,
OBS
everyone.
Studio and
Thank
going
you so
live.
much for joining me.
But
If you're
unfortunately,
joining me,
I apologize.
do not.
This was supposed to get
So,
way. I am. I am.
oh my
Goodness. Let me see here. I am still in the process of learning right now, and thank you so much for bearing with me. If you happen to be here and you're in the chat, I would love to hear from you. Comment what mailers that you've received, maybe a situation or scenario that you find yourself in or presented with. It helps others. If I see a lot of the same, I'll do a future short on a little deep dive on maybe that particular piece of mail that everyone seems to be getting. Also, just sharing these things helps one another out and become more aware. So there's that. I also want to apologize for not getting to this sooner. I know that I alluded that I would get to this far sooner than today, but things with life happen, trying to manage my career, my house, and the maintenance, and my family and friends, and the video content that I create. A lot of the video content that I create is created and edited all by myself, so it is very tedious. These lights are so bright. I think they're making me sweat, but I think I'm so worked up too that I'm sweating on top of it. So I'm going to try to just jump right into everything now, and I thank you very much for joining. Here we go. All right. Today, I want to talk to you about those too good to be true mailers that you've been receiving in the mail. Now, unfortunately, I have to tell you, before you start feeling like you're special, you're not alone. We are all receiving them. I myself have received offers from Upstart, The Point, Cash for Homes, and I gotta tell you, $60,000 I'm pre-approved for today, right now. Who couldn't use that right now? Which is why I really want to help you evaluate these things before you jump in the frying pan because of these too good to be true offers, so that you learn how to respond versus react. Let's get into it. Today, we're talking about unlocking your home equity. Did you know that today American homeowners are sitting on a record-breaking $34.5 trillion in home equity? It sounds like a massive financial victory, but there's a catch. For most people, that wealth is trapped. Wall Street, lenders, and financial companies, they all know this. And they are all aggressively competing for a piece of your home equity. Now, to understand how this works, I want you to think of your home equity like a giant digital savings account. It is the difference between what your home is worth today minus what you still owe on your actual mortgage. But unlike a normal savings account, you can't just go and withdraw all of it whenever you want. This is where something called tappable equity comes into play. Tappable equity is the portion of your home's value that banks will actually allow you to borrow against. And here's why you can't touch all of it: the 20% rule. Most lenders require homeowners to leave at least 20% of equity untouched. Think of it like a financial airbag. If the housing market crashes and property values fall, that cushion prevents homeowners from owing more than the home is actually worth. So even if your house gains hundreds of thousands of dollars in value, you may only be allowed to access a portion of it. And this is exactly where companies like Upstart and The Point step in, or depending on how you look at it, where they seize the opportunity. Now, there are three major home equity offers that most people are seeing in their mailboxes right now. Number one, your home equity loans. You borrow a lump sum and you pay it back with interest. Number two, your HELOCs, your home equity lines of credit. Think of these like credit cards that are backed by your home. And number three, your home equity investments, or sometimes called shared equity agreements. This is where a company gives you money today in exchange for a percentage of your home's future value. And here's the reality no one explains clearly. Not all equity access is equal. Some options cost you monthly. Meanwhile, other options cost you long-term wealth. So let's break this down simply using real-world examples. Let's begin with Upstart. Upstart offers your HELOC, your home equity line of credit. This is important. It is a loan. You are borrowing money and repaying it with interest. The easiest way to think about it is this. Imagine you have a credit card that uses your house as collateral. If you stop paying, your home is the backup plan. Now let's talk about the traps that most people don't realize are hiding inside this product. The first one is one that I call the must-spend rule. Most credit cards allow you to decide how much you want to use. Upstart doesn't work that way. If they approve you for a $100,000 line of credit, they may require you to immediately withdraw 80% of it. This means that you instantly owe on $80,000 even if you only needed $10,000 today. And if there's a 5% origination fee, you may actually only receive about $95,000 total available from the $100,000 approval, while still owing interest on the required $80,000 draw. And from day one, interest starts accumulating on the entire $80,000 draw. Think of it like going to Costco for a gallon of milk and being forced to buy an entire warehouse pallet instead.
That's the rule. That's the goal now.
I'd love to hear from you in the comments down below if you know who my Costco creep is.
What are we doing? What's going on? What is this?
I couldn't help myself. I have to have fun too. Now, let's talk about the second trap, the 3-year deadline. Traditional HELOCs often allow homeowners to borrow and repay over the course of 10 years. Upstart gives you just 3 years to use the entire line. After that, the borrowing window closes permanently. Imagine someone handing you a financial emergency parachute, and after 3 years, they take it away, whether you still need it or not. Then comes what most homeowners experience as the biggest shock, the payment shock. For the first few years, your payments, they may feel manageable because you're mostly just paying interest. It's like renting the money. But once the repayment phase begins, everything changes. Now you're paying the actual borrowed amount plus the interest. So a payment that was once $500 a month could suddenly become $1,200 or even $1,500 a month. That sudden jump can actually crush household budgets, especially if taxes, insurance, groceries, utilities are all rising too. And then there are the hidden fees. Upstart may charge an origination fee up to nearly 5%. So if you're approved for the $100,000, they might immediately keep $5,000 in fees, meaning you may only receive $95,000, but you will still owe interest on the full $100,000 you were approved for. And it's important to remember that many of these rates are variable. If the economy changes and interest rates start to rise, that means your monthly payment will rise too. You know where I'm going with this again, right? Now, to be fair, there are advantages to a HELOC. Now, if you borrow $50,000 and you spend about 10 years paying it back, you may ultimately repay around $90,000 total, including interest. Now, that sounds painful, but here's the key difference. Once that debt is gone, it is gone. If your home later doubles in value, you keep all of that appreciation. Every dollar, that future upside belongs entirely to you. So the simplest way for me to explain a HELOC is you pay monthly now to protect your future wealth later. And also, depending on your situation, some HELOC interest may be tax deductible, depending on if you itemize your deductions. Now let's move to the point. Point does not offer a loan. This is called a home equity investment or a shared equity agreement. The easiest way for you to think about this is that you are bringing in a silent business partner into your home. They give you cash today, and in exchange, they get a percentage of your home's future value. And this is where many homeowners get blindsided, because while there are no monthly payments, there are traps hidden inside the fine print. The first is what I call the discount trick. Let's say your Wallingford home is worth $400,000 today. Point may apply something called a risk adjustment. That means they pretend that your home is only worth around $292,000. Why does this matter? Because when you eventually go to sell your home, they calculate that share starting from that lower number. So even if your home's value barely changed, it can appear as though your home has had a massive appreciation, and Point gets a percentage of that. Again, imagine two people are starting a race. One starts at the actual starting line. The other secretly moves the starting line backward. That's essentially what the discount adjustment does. Then there's what I call the renovation tax. Let's say you use Point's money to remodel your kitchen. You go through months of managing contractors, living through contracting dust, making design choices, adding real value to your property. The renovation increases your home's value by $50,000. Guess what? Point takes a percentage of that increase. I want you to imagine hiring a business partner who never lifts a hammer, but still expects a piece of the profits from your hard work. Even though you did the work, you took on the stress, and you created the value. Which brings us to the biggest issue of all, the giant final bill. Because Point requires no monthly payments, that debt quietly grows in the background over years, sometimes decades. You know where we're going again. At first, this sounds amazing. No extra monthly bills. No payment pressure. But eventually, the agreement ends. And when it does, you have one massive lump sum. Here's a real world style example. A homeowner takes $50,000 today. 20 years later, their homes appreciated significantly. Now they could possibly owe point 250,000, 300,000, or even more. That money comes out directly of the homeowner's equity. And if you can't pay it, you may be forced to sell the home just to settle the agreement. Then come the hidden fees. Point can charge processing fees up to 3.9%. There are appraisal fees, title fees, government recording fees, and settlement costs when the agreement ends. So again, somebody who's approved for $50,000 may only receive about $45,000 after deductions. Now, to be fair, Point does solve a real problem for some people. There are no monthly payments. Qualification can be easier. And if the market did crash, Point does share some of that downside risk. But in a rising real estate market like Connecticut, especially Wallingford, Connecticut, shared equity can become extremely expensive over time. And this brings us to the biggest difference between these two products. Upstart charges you while you borrow. Point charges you when you succeed. One creates monthly stress now, while the other can quietly drain long-term wealth later. So what happens when you sell your home? With a HELOC like Upstart, you pay off whatever balance remains and you keep the rest. Simple. Now with Point, the mortgage gets paid first, then Point gets paid their share, then you get whatever is left over. And it's important that you know, for some homeowners, that number is drastically smaller than what they expected. So here's the honest bottom line. A HELOC is generally short-term pain for long-term wealth retention. Shared equity agreement is often short-term relief for long-term wealth sacrifice. Neither option is automatically evil, and neither option is automatically perfect. But as a homeowner, you need to fully understand what it is you're giving up, especially in appreciating housing markets like Wallingford, Connecticut. Because the financial decisions that you make today could completely shape the amount of wealth that you own in 10, 20, or even 30 years from now. Now I have to ask you to do something really important and listen. If you are a homeowner who is thinking about selling, refinancing, renovating, downsizing, or even just trying to understand your options, please don't feel like you have to figure all of this out all on your own. Now, one of the biggest mistakes most homeowners make is only talking to one lender or one vendor or interviewing only one agent and thinking or assuming that that's their only path forward. I work with trusted lenders and vendors. All you need to do is just reach out to me, scan my code. You can find me via social, through my email, message me on various different platforms, call me directly or shoot me a text. I don't want you to feel as though you're going to be pressed. We can just have a conversation about your situation, and I can put you in touch with people that can talk to you about all of your options. Sometimes there may be a far better option than giving away a large percentage of your future equity. And that being said, sometimes a shared equity product may genuinely make sense for someone depending on their situation. The real point is you deserve to understand all of your options, including the pros, the cons, the risks, and the impact on your future wealth. No pressure, no sales pitch, no obligation, just a real conversation and guidance. So, if you're on the fence about selling, tapping into your equity, or trying to figure out your next move, connect with me. Let's simply talk. I'm here to be a resource for you, first and foremost. All right, y'all, so that is going to wrap up this first live stream. Thank you so much for bearing with me. And I am definitely going to start doing a lot more testing. I've already thought about it, just doing little lives where I introduce possibly a short video or something like that of that nature. But yeah, I have a lot more testing that I need to do so that I really get my live stream game up to par. I want to thank you so much for tuning in. And until next time, I just want to say thank you for joining Connecticut Home Glow. Keep shining. Whitelaw here from eXp Realty.